This is Equity Access. Welcome to an informative series, Stock Market Savvy, where I show you the ins and details of the stock market. I'm Ibn Mabunda. Let's go. Now, in the previous installment of Stock Market Savvy, we saw Tasha and Simba launching Gogo's Chicken, which became a hit, eventually listing on the local stock market. Now, to do that, they had to go through what is called an initial public offering. Initial public offering. What is that? That is the issuance of shares of a company for the very first time through an auction system. I'll break it down for you. To take you a step back, remember that Tasha and Simba put together a team of independent experts. Among them were financial advisors. The financial advisors were to help them with the valuation of the shares. That was a process. What was that process? The process basically was when the financial experts looked at the financials of Gogo's Chicken over the past 3 years of operation. The financial statements being their cash flow statements, income statement or profit and loss statement, and the balance sheet, which is conventionally referred to as the statement of financial position. With that, they also did some kind of a forecast, which is more of a feasibility study, which looks into the profitability potential of the firm in question, Gogo's Chicken, which helped them formulate a per share value of the company. That is the value of every single share in Gogo's Chicken. Remember, when Gogo's Chicken was listed on the stock market, only 40% of Gogo's Chicken was put out onto the market, which translated to 40,000 shares. So this value we're talking about is the value of each of the 40,000 shares, if you get that. I know you got it. Now, according to the evaluation, Gogo's Chicken is worth $10 million. Now remember, only 40,000 shares out of the 100,000 shares was put out for the public listing, which means the 40,000 shares are worth $4 million. Do the math there and you'd realize that the 40,000 shares would translate to $100 per share. The $100 value is actually the asking price of the shares of Gogo's Chicken. With an asking price of $100 per share, that then became the value that Gogo's Chicken took with them to the market. On the other hand, the investors were also ready to buy the shares at their own price, which is the bid price. So in Gogo's Chicken, while their asking price was $100, the investors were willing to pay as much as $150. So that then meant that they had to meet at a middle ground or at a common base, which is called the convergence price or the discovery price. So that discovery price then became $125. Normally, in the initial days of trading, there is a fluctuation tendency in the value of the share as the market seeks to establish what is called a trading equilibrium. To break it down, that is the difference between the asking price and the bid price to reach a convergence place. But how that happens is eventually the two have to meet at some point, and that is what we are calling the convergence price. In the next installment, we're going to look at the mechanics behind fair valuation of a share. Want to know what that is? Next installment. Please do visit our Twitter handle Equity Access, our website www.equityaccess.net, and of course our YouTube channel Equity Access. Thank you very much for watching. Check you later.